Hello everyone, and welcome to the final lesson, lesson 2. Now, you'll recall that we, in the last lesson, talked about how line of credit is simple interest and loan, that's any loan, student loan, auto loan, construction loan, any loan, home loan, all right, are amortized interest, okay? So now what we're going to do is we're going to dig deeper into what that really means. What does simple interest and amortized means? And we're going to give you the definition by way of illustration. Okay, so before we do that, we want to let you know that we've paid down, as you can remember back in the other lesson, that we paid down our credit card in 6 months versus 4 years. Had we done it the bank's way, paying that minimum payment of $600 a month, we would have been paying for 4 years. And instead, we got rid of $12,000 in 6 months. Isn't that awesome? Pat yourself on the back. Good job. Okay, so we're done with that. But did you know that getting out of that credit card debt was actually a bad thing? Okay, we need that debt. And we're going to explain to you further as we go along. Okay, so that's done. Now we're going to get into the difference between simple interest and amortized interest. All right, here we go. Watch this. And I want you guys to really pay attention to this. 32 degrees, 0 degrees. Can we agree that 32 degrees Fahrenheit and 0 degrees Celsius is the freezing point of water? Can we agree on that? Okay. Okay, now, if I do this, okay, can somebody tell me what is warmer? Okay, I'm putting a 1 there. 1 degree Celsius or 32 degrees Fahrenheit? Which one is warmer? Come on. Okay, now some of you are saying 1 degree Celsius is warmer. But I would like to ask you a question. How in the world can you say that? Isn't 1 less than 32? I mean, that's what I got taught in school. Okay. Oh, it's a different scale. Is that what you're talking about? Right, it's a different scale. And guess what? The banks have done the same thing to us, okay? They never taught us the difference between a line of credit, simple interest, and amortized interest, which is loans. You see, when they say 6% on a house, everybody goes, wee, jumps up and down. Okay, when they mention 21% on the credit line, everyone's like, whoa, that's high interest. Not really. Because did you know that 6% in the amortized section is actually bigger than 21%? Oh, absolutely. And that is because this is amortized. How do you calculate amortization? Okay, so take this number, okay, any number that's amortized, times it by 2, and then add a 0, seriously. And that will be the approximate of simple interest. So this is what I mean. You take this number, 6%, multiply it by 2, and then add a 0, and about 120% is what you will really be closer to paying than the 6% interest. Okay? So at the end of 30 years on this $200,000 loan, you would have actually paid $420,000. Okay? Absolutely. So that's amortized interest in a nutshell. All right? So let's remember, we don't want amortized. We want simple interest, okay? And I'm going to show you how to have this simple interest work to pay down this interest so that it doesn't take you 5 years, or excuse me, it doesn't take you 30 years to pay down that mortgage. It actually just takes you the 5 years. Okay, are you ready for that? All right, let me show you one more thing about amortized interest, okay? Let's take this amortized interest right here. We're going to draw up a schedule. This is $1,200 a month, as you can remember. $1,200 a month, that's going to be split up in the amortized schedule field. That means that there's going to be $950 going to interest and $250 going to principal. P stands for principal, I stands for interest. Okay? And this is how your schedule will look. Over time, they'll switch places. You'll pay less in interest as time goes by, and you'll be paying more towards the principal as time goes by. Okay? So that at the end of 30 years, towards the end of 30 years, you will be paying $250 towards interest and $950 towards the principal. Okay? Now, we normally, being humans, what do we normally do? We refinance, which is one of the worst things you could do, okay? We refinance, okay, at the 5 to 7 year mark. What does that mean? Well, that means that we start the interest clock all over again, okay? And we are stuck in a debt loop, which is where the banks want us. All right, stuck right there in that debt loop. Now, let me show you what this looks like. Okay, you've been paying, let's say, for 4 years, the $1,200 a month, using your old method of just taking it out on a cash basis, paying your mortgage, being a little good boy and a little good girl, doing what you're told. Okay, watch this. 48 months. Okay, that's 4 years. This is what your payments are going to look like. This is how it's going to be split up. You would have paid $13,000 to the principal, and in interest, you would have paid $44,000. You paid $57,000 total, okay, for the 4 years, and that's split up like this. $13,000 goes towards your principal, and $44,000 went towards interest. Isn't that cool? No? No, it's not cool? No, not at all. Okay? Let me show you another way. All right? So, and I'm going to need to switch markers here because this is good news. All right? Red is signifying the loans, and green is going to be signifying the lines from now on, okay? The line of credit. So let's look at this, okay? We have a chart, and remember, we're done paying off our credit cards, all right? The line of credit is done. So now we're going to utilize our line of credit, and we're going to take out, what? $13,000, because remember, our limit is $15,000, all right? Our limit's $15,000. So we're going to be $13K, $15K is the limit, okay? Now, we take out the $13,000, and where's that $13,000 going? It's going towards the principal. Absolutely. It's going towards the principal. So now we're going to be jackhammering that principal down, okay? So how do we pay it back? Remember, the same way that we've paid back the $12,000. Remember that? We're going to put our whole monthly income, month after month, into our line, and we're going to pay our bills by our line of credit, okay? It's not a payment, it's a transfer. That's how we'll look at it, okay? It's a transfer. So we'll smash that mortgage, okay? So now that mortgage is minus $13,000 because we've paid it with our line of credit, okay? Now we're going to pay back our line of credit by how? Taking that monthly income and putting inside the line of credit. All right. Now here's how it looks. It goes, boom, the monthly income of $5,000. Then remember, there's $3,000 of expenses we still have. Okay, so it goes up and down, up and down, up, down, up, down. And in 6.5 months and $1,400 in interest later, you would have paid back that $13,000. Now, what happens at the end of the 6.5 months? You do it again, right? You take out another $13,000 and you keep making your monthly payments. Absolutely, absolutely. And then after the 6.5 months is up, what happens? You do another $13,000. Okay? Now, let me show you the difference between doing it the loan way and doing it the line way, or doing it the wrong way and doing it the right way. Okay? Watch this. Six and a half months. Principal, you paid $13,000, and interest, you paid $1,400. Versus doing it the loan way, 48 months it took you to pay $13,000, and in interest payments, you paid $44,000. Now, which one seems right to you? Okay? Absolutely. After 5 years, you're done paying off your house, versus after 30 years, you're done paying off your house. Which reality do you want to step inside of? Okay? These numbers are real. Okay? It can happen for you. Now, I understand this may not be for everybody, but it is for those that have bought this class, right? All right. So look, this is awesome because now after 5 years, we're going to jump ahead. After 5 years, guess what? We've paid off our house. So what happens up here? That's right. It's no longer an expense. That is cash flow. So we're going to add another $1,200 down here to our cash flow. Now we're $3,200 in cash flow. So what do we do now that we have all of this cash flow? Oh, we're going to rapidly pay down our auto loan. Okay, now if it took us 5 years to pay off $200,000, how long do you think it's going to pay us? How long do you think it's going to take us to pay off $16,000? Let's say the car payment was $20,000. How long is that going to take? A year? Maybe a year and a half if we had a rough year, right? Absolutely. So now that is going away because remember, the more cash you have, the more cash flow you have, the stronger and more rapidly you can pay down your debt. So this chart here, you see these lines? It's going to get steeper and steeper and steeper as that cash flow builds up, okay? So we've paid off our car, okay? All of this is paid off here. And now we scratch that out. And where do we add that? That's no longer an expense, remember? We're going to add that to our cash flow, okay? $3,800. Yeah. Like that's awesome because now we're going to rapidly build, rapidly pay down our debts. That's how you do it, okay? You utilize the bank's tools. That's what they're there for. So now that we have no debt, we got the loans done, the cars are done, the line of credit is done, we still need debt. You remember that? We need good debt. So now what are we going to do? Well, that's when we graduate to another level. And that level is called real estate investing. So listen, that's going to be another class in the near future. Right now, just take these concepts right here, these velocity banking strategies, rewind this video. Oh, you can tell that I'm old school. I'm saying rewind. That's a tape. So play this video over again. If you don't understand the concepts, go ahead and let me know as well. I'm definitely available for you if you have any questions. This works. I'm actually on schedule to pay off my car this year utilizing the strategy that I've learned and that I'm now teaching. So please, if you have any questions, don't hesitate. Hope you enjoyed the class. You take care. God bless.